everyone, welcome back to our YouTube channel. I'm Angela from the Central Bank of Armenia, and in this video we will show a practical illustration of the workhorse model of the FPAS Mark II analytical framework called endogenous credibility model. So by the way, we have a video on our YouTube channel where I teach students from the American University of Armenia the ENDOCRED model. So please check out that video where I go into a lot of detail on the main equations and assumptions of our workhorse semi-structural model. So without further ado, let's start. So we're going to apply the FPAS Mark II analytical framework to the summer of 2021 in the United States and show that if we had used this framework at that time, it would have made everyone's life so much easier. And here we take inspiration from Louis Armstrong and think, what a wonderful world it could have been. So, what was happening in the summer of 2021? Basically, inflation had begun to increase to rates not seen in the US in years, and there were two main schools of thought at that time that argued about the causes and nature of inflation. So the first group was led by people like Lawrence Summers, who argued that the combined fiscal and monetary stimulus was too big. In fact, he called it the worst economic decision of the past 40 years. And this group was worried that the stimulus would create additional excess demand pressures, which would make inflation rise even more and stay elevated. In other words, that inflation was going to be persistent. So the second group argued that inflation was transitory and not persistent because it was caused by supply-side factors related to disruptions in global supply chains due to the worldwide COVID lockdowns and restrictions. From this group's point of view, these disruptions were temporary, and once they went away, inflation would return back to the target levels. So with this background in mind, let's use the FPAS Mark II framework and develop some scenarios. So our case A scenario reflects the thinking of the first group, the idea that inflation is persistent and therefore policy rates will need to be higher than what the market currently expects in order to hold demand and prevent core inflation from further ratcheting upwards. So our case B scenario reflects the second group's thinking, essentially what a lot of policymakers argued at that time, that inflation is transitory. So therefore, the policy rate needs to be lower than what the market is expecting, particularly because the economy is still fragile and recovering, and high rates could create a deflationary environment. So, but that's not all. Many people at that time were worried about tail risks, or what Olivier Blanchard calls dark corners. And the major concern here is that not only was inflation persistent, but there was a real risk that the Fed was behind the curve and inflation expectations would ratchet upward significantly. So this weakening in Fed's credibility would mean that the scale of the eventual policy response would need to be magnified, which in its turn would create stagflationary risks. So let's take a look at our case A scenarios and the main results of our model. So if we look at our case A scenario, which is the green line in the graph, we're starting off our economy with an output gap of 0.5, which is accompanied by inflation at around 3.5%. And here, in order to bring inflation back to the target, the Fed needs to increase its policy rates by more than what market expects. And as we have an endogenous credibility model, we can see that because of the persistently high inflation that is persistently above its target, the Fed started to lose its credibility. And here we're thinking about credibility as a stock that the central bank accumulates over time and loses very easily if the inflation is persistently above its target, and when the central bank starts off with high credibility and when over time it loses it. In order to reach its policy objectives, the central bank needs to amplify the magnitude of policy tightening. So next, if we look at our case B scenario, which is the orange line in the graph, you can see that in this scenario, because inflation is transitory, in order to bring back inflation to the target, the Fed doesn't need to raise rates as aggressively or as quickly as in our case A scenario. So our case X scenario, which is the purple line in the graph, you can see that it reflects the tail risk scenario and in many ways looks a lot like what actually ended up happening in the economy. You can see that inflation is significantly higher than what people were assuming in the case A and case B scenarios, and here the Fed would need to respond much more quickly with much more aggressive increases in the policy rate to bring back inflation to its long-term target in a reasonable time horizon. So, to conclude, if the policymakers had adopted this framework and this way of thinking about tail risks, they would have been able to communicate more clearly to the public what those tail risks were, and more importantly, what their policy response would have been in this scenario. This will avoid the significant hits to the central bank's credibility and the additional risks that we have seen materialize since then. And so these are our illustrative case A, B, and case X scenarios. And it's clear from what I just said that this reflects what economists and policymakers were thinking about it at that time. And if the policymakers had used this framework, we would have been in a much healthier position and in a much wonderful world. So isn't it fascinating? Thank you so much for your attention. Continue following our YouTube channel. Have a nice day. Bye.